we're here to discuss shifting mindsets and emerging trends. Where is the opportunity to create wealth? So, as we all know, the world is constantly evolving, and with it, the economy and the way we do business. In order to create wealth, it is important to stay ahead of the curve and identify emerging trends that provide opportunities for growth. On such emerging trends is the shift in mindsets towards sustainable living. With increased awareness about climate change and its impact, there is a growing demand for environment friendly products and services. Companies that provide sustainable alternatives have a huge such as the above have a huge potential for growth and create wealth to discuss. And to discuss this in detail, we have with us a panel of esteemed experts of the industry. Mr. Anunaya Kumar, President, Sales and Distribution at IIFL Wealth and Asset Management. Mr. Prateek Pant, Chief Business Officer of WhiteOak Capital Asset Management Company. Mr. Vikas Sachdeva, Managing Director at Sundaram Alternative Assets Limited. Now, I'll be handing over the mic to Mr. Vikas Agrawal, who will be moderating this session. Over to you, sir.
Yeah, thank you. Thank you, Pragya, for introducing. Hello, gentlemen. So, thank you so much for accepting our request and taking the time out and joining this session. Thank you, Anunaya. Thank you, Vikas, and thank you, Prateek.
Thanks, Vikas, for having us.
Thank you, Vikas. Good, feels good to have been in this elite panel.
Thank you. So basically, you know that AIF and PMS Conclave 1.0 is basically the agenda is to kind of educate the investor community as a whole and empower them with more knowledge and wisdom. So there is a saying that if you keep upgrading yourself, you keep learning. And today's topic is very unique. We picked up this topic called how do you identify these different trends which are coming up. So different trends and different mindset altogether that you pick up those trends at an early stage. So today what we're going to do is we will have a conversation and I'll be seeking your opinion because you bring about more than 2 decades of experience, all of you, and have been into this industry. And at an organization level you are managing so many portfolios. So we'll try and read your mind, we'll try and understand how do you pick up those trends at an early stage, and we talk about the change in the mindset as well. So my first, I would straight away go to Mr. Vikas first. Mr. Vikas is the managing director at Sundaram Alternates, and he brings about more than 2.5 decades of experience on the table. So Vikas, my first question is that when you are looking at identifying trends, how do you see these so many demat accounts getting opened in the industry? Before COVID, the total number used to be less than 3.5, 4 crores, which has grown to more than 10 crores as we speak, and numbers are only going up. I keep hearing that it is 10,000 accounts a day. So where do you see the competition going up? And second is more adding to the first question, do you see these numbers are helping our equity markets to sort of be in line with other markets or outperform?
Interesting question. I think you sent me the first question, which is the most difficult question to answer because you're talking about probably 2 different industries. But let me see how I can answer this. I think the key word here is trends. We're trying to identify trends, and I think one of the key things which is coming across is that people's exposure and comfort with equity as an asset class is increasing. Way back earlier, people used to always associate equity with some sort of speculative activity. I think that speculative activity still persists, but more and more investment into this asset class has started coming in. If I have to answer your question in a different way, I think once people get used to equity as an asset class, understand the risk, understand the volatility, then they try to go beyond a shorter horizon. And that's exactly what is happening. The trend which is now starting to happen is money starting to come into managed portfolios, whether it is through the mutual fund route or through platforms like Small Case, and in some cases where the risk appetite is higher as well as the amount to be invested is higher, it comes into alternates. A very funny thing, I was telling somebody the other day that when I started my career, mutual funds used to be the alternates. Now mutual funds has become mainstream, right? So that itself shows you how a complete entire generational shift has happened in terms of looking at equity. The second part, very quickly, is that at the distribution end, at people who are service providers to these investors, I think there is an increasing realization that most people tend to trade with a little bit of their money but invest a lot more. So most of these outfits themselves have started looking at offering premium products to their HNI, ultra HNI client, thereby increasing the duration of equity which is coming into the system.
All right, great. So I think that clearly indicates what you rightly said. In fact, I remember 20 years back when I entered the industry, I used to share what is mutual fund and how to
Yeah,
invest in mutual fund. At least gone are those days. So mutual fund to sahi, and it brings about almost two and a
absolutely.
half decades of track record. Congratulations to all of you. Under your able guidance, you and your team is doing fantastic job of reaching out to every small investors and taking their systematic investment plans and helping them to attain their life goals. So my second question to you, Anunaya, is that we saw that, and currently there has been discussion going on that we saw suddenly we saw the circular that SEBI said the Ministry of Finance is also very vocal about it, that indexation is going away from debt funds, and people used to keep their savings in the debt fund. Now, but the question is, what do you think? How would this affect the CAT two, particularly the debt portion of the alternate investment funds? Because we are here to talk about AIFs and PMS industry.
Yeah, thanks, Vikas, and a very relevant question in today's time. I would say, since you mentioned very specifically, let's limit our discussion to AIF and the PMS because that's an alternate platform we are talking about. So I am running from a 14 lakh crore industry. I'm now straight away zeroizing to 3.5 lakh crore, which is basically the addressable market in the duration owned by ultra HNIs and retail. And if we further, take a funnel approach to it to look at the audience, which is an audience for the alternate only, I think we're talking about 1.5 lakh crore kind of a money in this space where people will take a call what is to be done. Now, let's step back for a second to see how this industry was till a couple of days back. We were looking at generating a certain returns, which could be done through a maybe medium-term fund, a dynamic bond fund, or a short-term fund. Why? Because taxation by virtue of indexation and all were leaving a lot of things on you on a platter to take the net yield at home being far and more effective. I'm talking about a 10% without a 20% with indexation, and a CAT 2 being a pass-through and straight away getting to a marginal taxation. The arbitrage was big enough for one to derive the similar return by taking onboarding a lesser amount of risk. Now, what has happened is the moment this circular came into effect, we are talking about a level playing field. Now, advisories or the decisions, at least for now, hence going forward, is not based on taxation, arbitrage, which we used to look at till yesterday. So what are the factors that we are looking in today? Is number one, what is the YTM? And more than a YTM, what is the YTM if after taking into account the expense, the net of expense, what is available? Because that is now going to be the deciding factor. Now, when you look at it, YTM adjusted to expense, and then you look at what are you getting in other instruments, then you see that, look, if I'm taking a 3-year, 4-year, or 5-year view, if my allocations to the debt is a part of my asset allocation and not I'm looking at parking the money as a money at call, then the audience is very smart because this is anyway derived audience, because this is an evolved audience. People understand the quantum of risk which they are taking it while being on an alternate assets. Now they can take far and more informed decisions to look at CAT 2 funds, which could be a last back securitized assets. Something we can talk about an InvIT or a REIT oriented. Obviously, the quantum of risk in every decision that they take are very different. But at least I can see a lot of money will start moving into this segment, CAT 2 segment, because people would want to leave the money being under managed category. They wouldn't be very keen on taking the call on their own. They will look for an advisory on that. And if advisories are coming it through a platform with the quality of assets and a YTM being superlative, I think that's the space where people will start migrating. Second thing, what has happened is MLD, which used to be the big market, almost close to 85,000 crore market size. That market pretty much has seen a massive, challenges. Now that is another quantum of money which you can look at.
Right?
So, even if I say, our own estimation, 20-25% of that money, which can potentially move into a Cat 2 kind of a space. If one out of 1.5 lakh crore that I'm talking about, if 20% of that money can move out of it, we are talking about a decent, this Cat 2 space, which was, a space not more than 35,000 crore of its space, can all of a sudden start seeing 40 to 50,000 crore incremental money every year start moving in. So there is a lot to do in this space. We strongly believe that you will see a migration of clients' money into this space, but the decision factor would be what liquidity are you looking at, and which is distribution of liquidity, and the most importantly, at what level of would you want to take those uh, decisions. That's where
Yeah.
we want to be.
All right, that clearly indicates that India is also picking up the global trends in terms of the way global AIF industry, the way it is shaping up. It has reached to $12 trillion out of $90 trillion of the total market cap. So this clearly indicates that India, which was negligible, hardly 40-50 billion dollar of the total size of the alternate investing in the industry, is now going to pick up from here, and obviously you will see other investors joining in. Prateek, I'm coming to you. Thank you so much for accepting our request once again. And you spent almost 22 years in the industry, good 10, 11 years on one side of the table, and then coming back to another side of the table. And again, you gone back to the same desk. So because you moved around, you gained a lot of knowledge in terms of how investor behaves, and you saw that what Vikaas ji rightly said, small investors becoming large, bigger and bigger. And so what's your view? Because as an organization, you have mutual funds, you have AIF, you have PMS. So firstly, there are two questions. One, how do you see these HNIs growing in India? If you can talk about some numbers, nothing like it. And second is,
Sure.
as an organization, where do you see how attractive the AIF and PMS offerings for these HNIs and ultra HNIs or family offices would be?
Sure. So thanks, Vikas. The fact that we are having this forum was quite unthinkable a few years back, right? I mean, after having Vikas spoke about how mutual funds was an alternate asset class, and now we've got a great audience listening into this entire conclave itself is a testimony of the fact that alternatives is now becoming mainstream, and the Indian investor is also getting evolved. So, coming to the first part, which you said on the HNI space, right? I mean, typically, different people have different ways of defining HNIs, but broadly, people say people more than $1 million type of a portfolio, 7-8 crores of exposure, are folks who come under that particular definition of HNIs, and then you have HNIs and family offices in that order. Now, finally, what people are looking at exposure is three asset classes, right? I mean, mota, right? It's you are getting exposure into equity, debt, and then the entire alternative space. Alternatives earlier used to be just gold, right? I mean, when you created asset allocation models, and I remember doing that earlier in my career in RBS, where we created strategic asset allocation models. The only thing which we would talk about on alternatives in India used to be gold, and that was available through certain ETFs. But over a period of time, starting with the evolution of long short funds, and then specifically, variants which have come on both credit as well as on equity side, you've seen a very significant, robust appetite which has been picked up by the HNIs, UHNIs who've actually looked at exposure which can be differing from where their markets are, right? So you would look at trying to track the market at all points of time, whether it was tracking things on the duration side on debt, or then long only on the equity side. But with type of volatilities which we've seen in India, and as Indian markets have been a lot more integrated with the global markets, people have tried looking at all weather portfolios where alternative asset classes in a true sense give them an exposure which is differing from the traditional equity and debt asset class. And in that type of a piece, we've seen significant conversations which clients have wanted to have with their advisors. In the earlier session itself, Sunil Singhania was talking about how new companies have evolved in India, how new asset classes, including REITs and some of these things. I mean, when you see, when he spoke about footwear industry or traditional wear industry, right? These companies did not exist in the public space, right? And you've had many of these opportunities which were available in the private ecosystem. So in the last in the last decade or so, you've seen many specialist managers on the private space actually launch products in that line. Similarly, around credit, right? Earlier, you could, while the mutual funds broadly defined that you can either do accrual strategies or credit strategies, but Anunya was talking about how the whole venture debt ecosystem has come up, or how credit has become a fairly important asset class post this whole debt tax indexation rule has gone out. That's made the entire space quite competitive now for alternate managers who are actually looking to explore opportunities on the credit side. Longshot has seen a fair bit of evolution in the last decade or so, where people understand what it is to have market neutral strategies and run the accrual plus type of a strategy at all points of time in the market. Similarly, real estate has seen over more than a decade different types of offerings. Initially, which started as pure equity around real estate, where you were getting into newer projects, but then again you had variants on the debt side on real estate. So the point is, Vikas, I think investors have evolved, and managers are now providing solutions across these asset classes. Initially limited, or you experimented with a few things, but now over a period of time, you've said you're running a 10 lakh crore industry between your PMS and AIF product basket, and I think that's a very, very significant space to be. And in terms of growth, you would see this space completely further increasing as newer and newer options evolve for investors looking at beyond just traditional asset classes. Sorry, what was the
Great.
second point of the question?
Yeah, so basically, just wanted to know your views because you are on the other side of the table. So, how do you see these HNIs investors when they are exploring this opportunity?
So I think, again, because it comes back to the basic, right? With equity penetration at just 5%, while we can talk about alternatives, but, there are, India being such a large market, you will see, an appetite for financialization of asset classes, which is going to happen, right? And it is going to, it started, of course, with many people now coming in much earlier in the journey of, and they understand that your eighth power of is the power of compounding, right? Eighth wonder of the world. With that type of wealth creation, which with your the macros being solid in place, with wealth creation opportunities continuing to be there, I think there are different products which are aimed at different segments, right? And even within that, there are multiple considerations. Like, we typically, when I used to have a discussion as an advisor, I used to ask clients four things, right? What is really your return expectations? What's the time period for which you can park your money away? Do you have liquidity requirements, which is there at any point of time, right? In this, and finally, what's your risk appetite? Now, around these four factors, each one of these products, whether it is mutual fund, PMS, AIFs, will you can rate them on a scale of 1 to 5, and then depending on the investor risk appetite is on these 4 points which I said, you will then tend to bucket different product offerings. So at WhiteOak, that's the approach which we have, where we believe that there is a massive opportunity available in India. The whole demographics are in favor. We're lucky we are in India, which has a solid growth story at this point of time, and the outlook continues to be very, very positive out here. The small companies which were in the unlisted space are now getting into listed. The smaller listed companies are becoming bigger because the sectors are growing right now. So all of these gives us enough tailwinds to actually look at creating this longer term story and the journey with investors as they look at their own savings potential.
Great. With that, we'll open the rapid fire round. Before that, let me just go to Vikas. Vikas, yeah, so you are the managing director for Sundaram alternate asset class. So that separate vertical clearly indicates that there is enough focus for alternates in India. Now, Vikas ji, you have seen mutual fund grow. Mutual fund to say you've seen this industry getting evolved in front of your eyes. Even you would have entered, you saw last 20 years, 24 years of particular time, you saw industry going to 40 lakh crores. Because so there is one school of thought which is being conventional. I mean, old traditional way of looking at things, like you build your portfolio in fixed deposits, mutual fund, thoda usme aap fixed income kar dijiye, and that's where the story ends. On the other hand, we saw that the new entrepreneurs who are coming in, they've shown a lot of interest towards alternate investments, and they want to participate in that from day one. So what's your views on that?
Uh, yeah, I suddenly feel very old sitting in this conversation. You just brought back memories. In fact, I heard about indexation. I think we were one of the first ones to start talking about indexation. But before I answer your question, yes, you're right. At Sundaram, we believe that these are two very, very large spaces and they need specific focus, which is why there is a managing director for the mutual fund and there is a managing director for the alternates business. And I think we are probably the only a large group in the country to have two senior people at managing director level put in this place. Uh, in terms of the growth of this space, I think if you're looking at my experience has shown me that when you're looking at mutual funds, people want to convert their savings to wealth, and I think that's a very powerful motivator for people to invest. One of the reasons why people come into mutual fund vehicles like SIPs is because it's a simpler, easier, relatively foolproof way to compound your money and build wealth. But when you're talking about the HNI, ultra HNI segment, when you're talking about those new age entrepreneurs, there are two things we are seeing. Number one is they are looking at creating the wealth into abundance or wealth into a legacy. Yeah. So they are very clear that there is a risk involved, but they're also very clear that they want to preserve the capital as much as possible. In a nutshell, they're far more aware of where they're putting in their money. So this is private capital. They will go for 6 years, 10 years, 15 years, but they would want to know where they're going. And the whole idea is what sort of abundance can I create? The second thing which we've seen in terms of especially these startups, I think the general tendency has been to give it back to the ecosystem, give back to the ecosystem where they came in from and nurture further startups like them. Because someday, somewhere had supported, somebody has supported their startup which has grown manifold and they would want to do the same. So the influence is more towards private equity rather than listed equity. But by and large, the thing which I want to underscore is that the mindset is very different, the thought process is very different. And if you look at the growth of HNIs, which is being projected in this country, currently, I think the last available data is 7.65 lakh millionaires are there in this country at this point of time. HNIs classified as more than $1 million in terms of wealth. It's expected to grow by 75% over the next 5 years. So this is a very large segment of population which is looking at stuff beyond the conventional and is looking to give back to the society. So I think that's a fundamental change in mindset which I have seen happening in the this class of people who have made a lot of money.
Sure, thank you. Going back to Ananya, we are talking about shifting mindset and shifting, identifying the trends at an early stage. IIFL as an organization is the first one to understand this and moved ahead. If you look at the speed of the organization in terms of identifying the opportunities here, your total asset under management on the AIF and PMSI clearly indicates that from day one you're very, very focused. While you had a mutual fund license, you decided to restrict yourself to only one or two funds, and within that doing very limited aspect. While there was an opportunity for you to scale up your mutual fund because that is something which was scaling up any which ways, but you decided to stick to your strength forte and you decide. Now, can you talk to us about what made you to be on those lines? Number one. And number two is, where do you see going ahead? What within the category 1, 2, 3, which one you think is going to shape up very well in next 2, 3 years time? You are on mute, Ananya.
Oh, my bad. Sorry. So yes, you are right. As Vikas just mentioned, that Sundaram have taken a very unique approach of having a two leadership people managing the show, one for a mutual fund, one for a alternate. So I think it's like everybody picks a way to drive and grow. Yes, internally when we were looking at how do we really want to shape up our business, I think we wanted to be a specialist in a certain segment, and which is where the why because we always felt that two eyes, ideation and innovation, have been our core to the business. So we were the first one to come up with an idea of a pre in a private equity, pre IPO kind of a strategy. And why we could see, because we could see that one of the very unique thing that you will see with us is for example, Vikas Agrawal just walks into my office with a great idea and say that this is a great idea. I feel like I can help Vikas start the journey with a seed capital. Now, as the Vikas, starts the journey, does well in his business, I can give him a mid-stage funding, I can give him a pre-IPO funding, and through the journey, I can move him to the listed space. So he can actually travel the distance on his aspiration with me through and through. So we have got money is invested in the seed capital to the money invested in a pre-IPO. So that's, and then a listed space, which is in a category 3 that people are continuing with us. So I think that's a very, very unique thing. And why we could do it, because we could think that, many of the innovations which we are able to bring it. For example, the co-investment process when we were building it up entirety. And we could see that, we can also have a proposition where the investors who are there with us, we can build on a co-investment and we can get them to participate in those ideas, which he wouldn't be able to do it on his own. But being in the fund, we can help him do that as well. So I think that's the journey which we traveled, and we very consciously, we were very clear that let's be the alternate specialist during our journey. Let's keep our focus on a Cat 2 and a Cat 3, which is where we felt that, we have a lot of expertise to demonstrate. And the way we have done it, we have ensured that for every bucket, whether we talk about private equity, listed equity, structured credit, or a REIT and InvIT, we have a respective CIOs. So we never wanted one person to co-own 2-3 spaces, because every space needs a very, a very skilled approach, certain skill sets, expertise, and hence we wanted every bucket to be owned by the respective CIO. To that extent, we have gone in the depth of understanding those spaces. Obviously, while we're doing it, we knew that it's not easy to do everything at one go. So obviously, we kept our mutual fund aspirations slightly on a low profile while we are building it up. And within the mutual fund, if you see, whatever we have done in a way that, we have demonstrated being first, like our ELSS fund. Again, first in the industry on a passive with a 3-year indexation and all, why we felt that certain, numbers when we look at in the industry were not matching in, and we felt that let's have a passive fund to come out with. And that's where it is going on. Now, the second part of the question that you have asked, we feel that the Cat 2 has a lot of room to cover. Well, Cat 3, I don't see that too much of a differentiator that one can really bring it on a Cat 3, other than some bit of innovation that you can bring it. But otherwise, MF, PMS and a Cat 3 AIF, besides the quantum of your commitment moving from 500 to 50 lakh to 1 crore, very difficult to demonstrate too much of an innovations over there. But a Cat 2, whether you call it a dead part, which as I was explaining some time back, the kind of opportunity which has evolved post the circular coming up. But even on the REIT on an InvIT, so much to do over there. I think to us, the way we look at it, the times ahead would be the time for a Cat 2 non-equity space. While private equity will have their own journey. Last year, because of a lot of exuberances in the prices and all, that space was slightly on a lower profile. But now many of those exuberances have got settled in. Prices have come down to the levels which we feel are pretty attractive. So we feel now again private equity can also be a space which will start evolving. But certainly this year or a year, at least couple of years, will go to the debt part of the Cat 2, because that's where we see a lot of migration of money happening.
Sure. Great. So Cat 2 looks more attractive. Now going to Prateek. Prateek, there are 2 questions. So one to your current avatar, second is to previous avatar as an advisor. Okay, so let me, and you can take whichever one you feel you would like to answer. So first question is, at WhiteOak, do you have plans to come out with different AIFs in under category 1 and category 2? The second question is, as an advisor, when you look at what are the innovations or innovative ideas which can emerge in the alternate investment space, which investor community can take the maximum advantage and enhance overall returns? These are the 2 specific questions. Over to you.
So I'll start with the second one first, which is in terms of innovations which are happening in the AIF space, right? As I did briefly allude to that, when I was answering the previous question, the space has really grown with now different routes to markets which are available, and also the fact that there's a lot more awareness within the investor community about what type of options are available through financial instruments, right? Anunaya was just talking about REITs, InvITs. I think we've just seen the tip of the iceberg there, right? We've just got 5 products in that area. We've just yesterday you've seen the launch of an index, which will help in benchmarking performance. The moment you start benchmarking things, there is always potential to outperform benchmarks, right? And that's really what new managers would really look to do. Real estate is one of the largest, is not really one of the largest, it is the largest asset class in India. Real estate and gold are two asset classes which have traditionally been favorite asset classes, but more held in physical rather than financial format. And I think the journey of financialization within real estate is just about started. We've not even seen the tip of the iceberg there. Things which you see today, within equity and debt is something what you will see within real estate, right? Where people will look at how can you get steady income through good, high quality commercial portfolios on REIT type structures. You will see how you could participate in development opportunities. You could actually see funds coming up with distress assets. You could have specific asset classes around warehousing, around student housing. Many of these emerging asset classes which are there, which could actually happen. So I see there is definitely some opportunity which will be there in that space. Again, Anunya did speak about the journey on the private market side, and from having seed capital funds to pre-IPO funds, to a hybrid of these. I again think that with the number of startups which have been in India, where we've been among the top three markets now in the world in terms of unicorns which are getting created out here. Again, the fact that the consumer tech space is still bouncing, and very strong in India. The fintech ecosystem is pretty much the best ecosystem in the world and still addresses this large consumer diaspora. That's again an area where you will continue to see strong performance. See, we have to understand one thing, because that we talk about all this, but end-to-end funds which have actually raised capital, deployed capital, and returned capital, you can almost count them in your fingertips, right? In one hand today. So we've only seen about a decade or less, or slightly more, of private market funds which have been available in the market. And as people build track records, you will see many others following through, and again that whole ecosystem evolving in a big way. Derivatives being used innovatively within absolute return strategies is the other space which are there. So my whole point is today, if you have to really look at the alternative space, and I do agree with Anunya's assessment that Cat 2 is a space where you will start seeing many of these type of innovative ideas actually coming in our way, which are truly alternative and not really disguised alternatives, right? And that space with with longer drawdown processes and regular paybacks is going to be an important area for many investors. And that's the innovation you would see. You would also at some point of time see truly alternate asset classes. While there have been accidents in the past in areas of arts or exotic asset classes like wine, or people even collecting single malts and things like that. Who knows? I mean, these are I'm saying people are doing that in their private collection. Financialization of that has to happen at some point of time. So as markets evolve, as people understand, I guess one important thing which will happen for a few of these exotic things is truly the evolution of the more informed investor. I mean, SEBI had created a guideline where $10 million or so was the minimum requirement of investment capital which was there, and that we will see some managers take that up, and launch products which will target a more specific type of client base, for especially people who are running family offices or the UHNI segment which is there. Now, around WhiteOak's plan, I think our first phase was really building out our core, our core product offering. And Prashant Khemka, who's the founder, has spent 2 decades in really looking at the whole public market ecosystem in India, and parts of emerging market. And I think that foundation is there in place right now. Besides running AIF and PMS strategies, we've also had international products where we raise capital for India and for emerging markets at WhiteOak. In the next stage, interestingly, one of the funds which we run in UK, which is actually called the Ashoka India Trust Structure, which is listed on the London Stock Exchange, allows us to take exposure up to 10% in the unlisted space. So we have bought companies in the past in that fund, and many of those companies have now actually even been listed subsequently of our investing in those. So we've built a track record of that. So we will definitely look at the next stage, funds which can target both listed and unlisted space. And as we build our distribution strategy, definitely some of the other asset classes which I was talking about is an area. I think one thing which we are very sure about is, and Anunya spoke about it briefly in the way they run that in IFL. We once we do have an investor who understands that this is a product from WhiteOak, it needs to adhere to a certain return expectation, diligence process. So you then build a team accordingly who will be experts in that asset class to be able to offer that solution. So yeah, I mean, I can just say watch the space, and you will find us doing many more things in times to come.
Sure, sure. Thank you so much, Prateek. So now going back to Vikas, regulator is like a father of the industry. Obviously, ever since AIF got structured in India from 2011-12 onwards, we saw that this is shaping up very well. Today, the size of the AIF industry has reached to almost 5.5-6 lakh crores. Now, okay, we'll talk about other things separately, product wise, because you are at a senior level and you interact with regulators. Do you see any gap in terms of level playing field between these three instruments of AI, PMS, and mutual fund as far as regulator is concerned? Number one, and number two, do you think anything can be done or should be done either by the industry or by the regulator, so that more and more number of players emerge who can go and reach out to investors and explain these offerings in detail, so that the size of the industry grows?
Interesting question. So I think the way I look at things, the regulator is fairly clear in terms of how they're looking at different segments of investors. I think one of the manifestations is in terms of the minimum investment amount. And the lower the investment amount, the lesser the creativity and more the sort of tendency to protect the investor, quote unquote. So when you have a mutual fund, I think it is regulated to the extent that it's a retail investor. On the other hand, when you have an AIF, you're talking about the regulator being the father of the industry. I would say the regulator is also the mother of all opportunities. They allow you a lot of creative freedom. They allow you a lot of sort of ability to think. And I think in the last 10 minutes between Prateek and Anunaya, we saw a lot of options being discussed. All of this has been possible because of the regulator. And all of this is also possible because the investor at the other end understands the risk, understands the opportunities. In fact, he demands, he asks for different opportunities to come to him. He is a global citizen. He sees what's happening across the world. So willy nilly, he will ask for something which will match up to his risk appetite. And AIF is a platform which will get it done. A PMS, I would look at it as sort of akin to an open-end mutual fund. The only thing is the ability to have concentrated portfolios with a very high degree of risk management is possible there. And again, it will tend to be very volatile because it's not going to be exactly benchmark specific. It's more of an absolute return product in a way. The only thing which at times one wonders is that, they say that a cricket captain, you need to have a different captain for T20, you need to have a different captain for one day and for test because the mindset is very, very different. Sometimes one does wonder that in this entire thing about looking at three different opportunities, is there a sort of an overhang of a mutual fund perspective to look at protecting the investor? Uh, Protecting the investor is a very generalized word which I'm using, but I'm just saying that on one hand you're giving a lot of opportunities in terms of innovation. On the other hand, the streamlining which is being done has a lot of mutual fund overhang. I can share with you about this PMS benchmarks which have just come in. For example, this is a very initial draft, but there are just three benchmarks which have come in, and none of these benchmarks effectively encapsulates or captures, for example, a small cap portfolio. you know to my mind, all said and done, a benchmark is something which needs to reflect the ability of the fund manager. Okay, and if the benchmark itself is something which is in question, then the ability of the fund manager will always be very fluid in terms of being questioned. So these are things I think one needs to just iron out. And the good news is that I have always personally found that the regulator is very, very keen to listen to what is happening. I have not had a single instance wherein if you go with data and logic and feedback, the regulator does not listen to you. In fact, they'll take you very, very seriously. So I think that's a very good part. And this is an evolving space. The AIF industry is what, 10 years, 12 years old as compared to the PMS industry and the mutual fund industry. So there will be a few things which we need to iron out, and I'm very confident that at an industry association level and at a regulator level, things would be ironed out.
Sure. There are two things which are coming to my mind which I want to share. before I go to Anunaya and ask questions. So one is the way I see gap is, of course, we're not questioning anybody out here, just discussing and debating. One is when you run AIF, when you run PMS, Vikas, you pay brokerages separately, you know. But when you run mutual funds, it gets added up and it is beyond TER. So I'm sure the regulator is working out something, but to my mind, there is a gap which I'm sure the regulator is trying to fix this. Number two is when you have AIFs, which is again at the pool level, Cat 3, you have PMSs, you pay short term taxes. You know, but when you run mutual funds, you do multiple level of, and correct me if I'm wrong, multiple level of buying, selling, less than a year, you don't pay anything because they are considered as trust. So the way this indexation benefit is going away from the fixed income space, I am overconfident, and I could be wrong completely here, is that going ahead, maybe regulator may think that when we are putting up the short-term taxes at Cat 3 level and these instruments are paying on investors' behalf, tomorrow mutual fund guys also have to pay because it's like a not a level playing field, you know. So मतलब एक माँ के तीन बच्चे हैं, एक को सोफे में बैठा रहे हैं और एक को जमीन में बैठा रहे हैं. So
Correct.
I could be completely wrong again, but when it comes to taxation, I think everybody has to be treated same way. So this is one aspect, but nevertheless,
I can
as an
just
investor, I can always speak.
No, I think you mentioned the first point. I'll answer the taxation part second. I just missed out on the first point. You asked the question, the
Brokerage,
first point. So
brokerage.
I think from that point of view, my personal view, this is strictly my personal view, I think the way one should look at this is not the pricing or the commission part of it, what it is leading to. The general feeling is that any amount of tinkering in pricing, if you pay an upfront commission or whatever, it leads to mis-selling. To my mind, I think that is where we need to address the issue. So, if an investor invests, you have to talk to him and say, are you aware of where you've invested? And willy-nilly, if somebody is investing 50 lakhs to a crore, for that person to not be aware of where he's investing and get swayed by an advisor's opinion could be one in a thousand chance, as compared to maybe a retail product where it could be higher. Okay.
Yeah,
So I think that
because
is
I
where
was referring to the brokerage which is paid to the stock brokers. So when
stockbrokers.
you
Okay,
run
sorry, my bad.
AIF PMS, so as
I'm
an
very
investor,
conditioned.
you get extra money, right? 0.5% in AIF or maybe
Yeah,
0.3%, whatever. But when you have a mutual fund, the cost is added up in the stock
yeah,
price,
yeah.
and that is what our regulator talked about during the last conference.
Sorry, I was thinking more in terms of the recent circular which has come on alternates. But I think that is the reason why you have industry associations. Now, all three, आपने जो तीन बच्चों की बात की, one on the sofa, one on the ground, and all of that, all three of them have got regulators, rather industry associations, which are very strong, which are very powerful, and I think these associations are making the necessary discussions with the
I am
regulators.
sure. Yeah.
On the taxation part of it, I can just tell you about HNIs and ultra HNIs. And I'm sure my colleagues will agree with me on this, that they have their own way of how to plan taxes. Okay, they are far more savvy in terms of planning their taxes than what we give them credit for. More often than not, they're saying we're giving you private capital, which is long-term capital. Please make sure that you have very good risk-adjusted performance. Taxation is an issue, but it is not going to be something we'll kill you for. We'll manage that on our own. So that is what I can talk to you about taxation.
Sure, great. So coming to you, Anunaya, Prateek rightly mentioned that particularly in Cat 2, and I saw IIFL playing very, very important role in terms of raising money in Cat 2, and not from today, for almost a decade now, ever since it got structured and regulated, I would say, as a vehicle. Now, when we looked at 50 unicorns, 60 unicorns that India has produced, which Prateek talked about, we saw none of the investors, HNIs investors and ultra HNI investors, have created really a good amount of wealth through this because they were not in. I mean, most of the money has come from outside of India. So what's your views on that, and what is your message to investor community as a whole?
So I'll go back maybe around 12, 14 years back when I was just like Prateek, one of the advisors working for a multinational bank, and I was in a city called Bangalore, and we had some ultra HNI clients with whom money we were managing. And I remember few of them were telling me that, look, Anunaya, we would want to invest in startups. Now, 15 years back in India, the startup was a concept was emerging. And we were like telling them, sir, the quantum of risk that is there in the startups are very high. Why do you really want to take that kind of a risk? Why do you not be with the managed people at all? But that time there was nothing to offer. And many of these people have taken a route to that. Now, I don't know whether they really made money or they lost money. But the fact is that realizations, at least among the ultra HNIs, have been there for last 1.5 decade back, that this space will eventually become big. And all that it was needed is your ability to understand the companies, because out of the 100 companies that you would see in Bangalore, I think probably one or two, or not even one or two out of 100, maybe out of 1,000, maybe one would have become a unicorn or got closer to becoming a unicorn, not even a unicorn. So these are great words that we hear today, and then and when we do a post-mortem of looking back, then we say that look, the people had lost their opportunity too. But please appreciate the very fact, opportunities also come from an awareness. Opportunity do come from your ability to onboard the risk. Opportunity do come from ability to spend time in getting into and get a perspective of being an entrepreneur. Because when you are looking at these unicorns who have become unicorn of today, please be mindful that you need to have that mindset which is outside the purview of being an investor and become an entrepreneur, and behave and think like a Mukesh Ambani. He was very happy to let the money remain invested in a Geo platform, while all these shareholders kept asking him that what are you doing? Where is the money for us? But he kept investing because he had a vision. And none of these vision for 1, 2, 3 years. He had a vision for a decade. And he said, look, give me time over 10 years and then I will show it to you people as an equity shareholder for us in Reliance. What am I building? And today he has demonstrated that. My limited point is not that people haven't made money, but people, yes, the number of people who have made money were far and less, which actually became an opportunity for someone like us, someone like Vikas and a Prateek to offer a platform to them, while we were one of the first one to figure this opportunity and created our SOF series, right from 1 to 11, and one of the series that now getting matured this year, where we have delivered a decent CAGR to the people. And mind you, many of these CAGR could have been even more had we got our NSE listed, because all of these funds have got a reasonably good quantum of NSE, and look, none of us have a control on IPOs. When would the time of the IPO come? It's probably a bad luck for the investor that the moment we repay the money back because the time is over, and after 9 months the NSE IPO comes up, and then they will understand what kind of opportunity that they missed out. But the fact is, yes, while we could cite an opportunity, we created an SOF series which were like pretty much in a pre-IPO. Some of them are currently going on. We created a tech fund where we got the money invested in an opportunity like a Swiggy's and all, and those have created a decent wealth for the investors. So now so there are two ways. One is that if you have a time, you have an ability, you can read this thing well, you are well connected, and the most important thing, are you a member of that ecosystem? Because that ecosystem is very different from the ecosystem that we talk about in the listed space. You're in the listed space, the element of the information which pours in from multiple sources are immense. And many of them are available in the public domain, so you exactly know what is happening. But be mindful, despite the fact Satyam had happened. That's also a reality of life. So would you really want to be still a smart person to say, well, I'm a part of the ecosystem, I'm pretty well connected, and hence I have an ability to find out Zomato or a Swiggy on my own? Or would you really want to come to a platform like ours, Vikas's and a Prateek's, and say to it, look, we trust your ecosystem. We know that you have the ability to cite an opportunity at an early stage. And look, here we are committing the money. One of the biggest differentiator, Vikas, that IIFL so successfully have been able to demonstrate its capabilities in the unlisted, or I'm talking about a pre-IPO in this space, is the massive ecosystem that it has built in, being in the promoter group through our wealth management outfit. Because when you have a wealth management outfit, you are managing the monies of ultra HNIs. Many of them are the promoters. All these promoters have their own ecosystem of remaining connected with each other. And those also multiple times become a source of information for you on two counts. One is citing the opportunity, and second is sensing the opportunity. So you are able to sense it well enough. Why? Because you have the ecosystem to understand, is it worth a bet to take or not? And likewise, that ecosystem only will give you initial signal to say, look, there is an opportunity which is building up. Would you really want to capitalize on that? So I think these are very, very critical things when we talk about people missing an opportunity or capitalizing on opportunity. The real picture is your own ability to, understand what opportunity actually is.
Yeah, I think that's a clear message to all the HNIs sitting out there, is to identify the opportunities at an early stage, pick up the trend, because that's very important. I see 10 years of track record of IIFL building up, raising money under the CAT2 platform, and it's shaping up very well. So clearly, I think that's a message to them. My last question, gentlemen, before we conclude the session here, to Prateek. So Prateek, we saw that particularly in category 3 AIFs, we see some managers are able to utilize the platform, the Cat3 platform, more effectively and efficiently, I would say, and able to generate 2 or 3% additional alpha. I'm not saying that the returns are subject to, it's a function of the market, subject to various parameters. Now, there's a basic question which keeps coming from most of the investors. I have mutual fund, I have PMS, I have AIFs. And within AIF, as I said, some of them are really able to utilize it very well, while others are still learning. So what's your take on that? What would be the message from your end to those, say, ultra HNI investors, somebody who's got a portfolio more than 10 crores?
So, Vikas, as I did say, right, you go back to the same thing. What are the 4 things which drive your decisions, right? I spoke about return expectation, liquidity, risk appetite. So those are some of the factors which finally still drive the feature of a particular product. So, now, what works for Cat3? Now, if I have a structure where I'm able to lock in capital for a certain period of time, and I'm Vikas earlier spoke about running maybe thematic strategies or focus strategies or concentrated strategies. Now, or strategies which are by nature investing in stocks which could be a lot more illiquid in the small and mid cap universe, right? So if I can take larger exposures into those type of strategies, because I know the money is being given to me for a certain period, right? When I'm running a PMS or a mutual fund strategy, I provide liquidity, on T+3, right? Typically, you decide to sell and the money is there in your bank account. That's not what typically would happen in a Cat3 AIF, right? Because you've given me a mandate for a certain number of years to be able to do that. So my own orientation, when I start looking at future cash flow discounting models of investing into companies, tends to be companies where I can take a bet, not necessarily, when we're creating those portfolios, we could actually buy companies with a slightly longer runway in terms of generating. So it's again the same paradigm. What level of risk and return works for you? So you will target companies or have higher exposure in the small and mid cap universe, and that helps in increasing the return profile within an AIF, which I run for long only equities. While there are categories of investors, of course, who can only invest in AIF because of their own, regulatory requirements which are there. We've also got things like, taken specific approvals for US investors to invest into AIFs, which we are not necessarily able to offer within the PMS or mutual fund umbrellas. So the whole structuring of that is again going back to really what type of return, what time period, what is your liquidity requirement, and what is your risk appetite. The moment you start ticking boxes around there, then you will be able to slot that I can park some money away, right, which I don't need for the next 3-5 years, and look in terms of generating maybe 200-300 basis point higher returns versus what I would do in a traditional mutual fund. And that's the way we run these strategies, and that's the way an investor should also think about his portfolio, where he has a core portfolio which is built on the equity side through maybe stocks, mutual funds, or whatever it is, and then something which is locked away for a longer term return orientation which is there.
Great. With that, we'd like to conclude the session here. It was great speaking with all of you. I take this opportunity to thank all of you for contributing to the industry and taking the industry from one level to another. And thank you so much once again.
Because if I can just add, I think you're being too modest. There are people like you who are out there, entrepreneurs like you who are taking the baton and helping people like us build our industry. I think your contribution, people like you, have built this industry along with us. So thank you so much. I would like to congratulate you as well on this.
Yeah, in fact, I would second Vikas for a Vikas, which is to see, because it's very easy to be in the business of managing money, but to be in the business of imparting education, letting the people get the skill sets, and having a platform like this wherein all of us can come talk, and for so many people on the as an audience are getting benefit. I think that needs a lot of effort. It's not easy to do. So many congratulations to you and your team for bringing it up so well.
Wonderful.
Thank you, sir. Thank you.
Thank you.
Thank you, Prateek sir. Thank you, Vikas sir. Thank you, Ananya sir. It was where this was so great, and your insights was so informative. It was very nice to dig deep into these, and Vikas sir just moderated the session so well and asked the right questions, and we could have the session very informative. So thank you so much, sir.
Thank you. We'll
Thank
conclude
you.
the
Our
event.
pleasure. Thank you.
Thank you, Prateek. Thank you, Vikas. Thank you, Anunaya.
Thank you.
Thank you.
Great,
Thanks.
great interacting with you. Bye.